Welcome to Fitch Ratings Risks to Watch. Each video in this series will highlight the key credit concerns in a sector over the next 12 months. I'm Mike Taiano from Fitch's Financial Institutions team, and I'll be discussing consumer lending in 2019 alongside Ian Rasmussen from our ABS team. There are a number of moving parts impacting consumer lending currently. While several macroeconomic factors continue to be tailwinds, such as a sustained period of low unemployment, stronger wage growth, low fuel prices, growing household net worth, and moderate levels of inflation, some risks have emerged more recently. These include rising household debt levels, a loosening of underwriting standards by lenders in certain segments, downward pressure on home values, and rising interest rates. We also believe that the federal tax cuts have helped mask the credit normalization that had occurred through much of 2016 and 2017, which we expect to resume in 2019 as the positive effects of the tax cuts start to wane. As a result of these cross-currents, in Fitch's 2019 Industry Outlook report published earlier this month, we maintained negative sector outlooks for the auto finance and unsecured consumer installment lenders, while we have stable outlooks for the credit card, mortgage, and student loan segments.
Overall, we expect healthy consumer ABS collateral performance trends into 2019. Performance normalization will continue in core sectors such as prime auto and cards as delinquencies and losses increase to more normal historical levels. We expect this normalization to remain well within base case assumptions, which really leads to our stable rating outlook across most consumer ABS sectors. Subprime auto and unsecured consumer loan ABS remain more vulnerable to performance volatility given weaker borrower profiles and stronger competitive pressures. With this backdrop, Fitch expects to maintain selectivity when assigning ratings or maintain rating caps to reflect new and/or untested models and overall structural risks. While not our base case scenario, a shock that materially weakens the U.S. economy is a key downside risk to watch for in 2019. Outside of recessionary pressures, interest rate increases will impact some sectors more than others, but are generally felt at the originator and not the deal level.
Generally, banks are taking steps to protect themselves from the emerging risks. Armed with advanced analytics and the learnings from the financial crisis, several consumer-focused banks have been proactive by tightening underwriting standards, cutting available credit lines, and terminating inactive credit card accounts. Certain auto lenders began reducing their exposure to subprime in 2017, while others have reduced their exposure to residual values on used vehicles that come with leases. Conversely, there have been some banks that have become more aggressive in growing their consumer loan exposure as commercial loan demand has been more sluggish. Some of these banks have partnered with fintech loan origination platforms, which could create added risks.
Consumer ABS sector performance may diverge depending on how each segment responds to macro factors. Watch for late cycle behavior, namely loosening of underwriting criteria following rising interest rates and increased competition for continued origination. For example, in autos, rising interest rates and higher vehicle transaction prices may make buying a vehicle more expensive in 2019. In turn, because of competitive pressures, lenders may stretch out loan terms, increase LTVs, and move down the borrower credit spectrum. Pressures on underwriting standards are even more pronounced in sectors with heightened competitive pressures like the marketplace lending segment, where reduced origination volumes puts pressure on untested business models that are more volume dependent. Finally, consumer debt is now at its highest absolute levels, so loan payment priority, or how consumers perceive ongoing utility of debt balances, can also drive performance differences between asset classes. Loans that provide higher utility, such as cellular device payment plans and auto loans, should experience lower volatility than unsecured personal installment loans. For all of our 2019 Outlook reports, please visit our website.